Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenivek on Bloomberg Radio.
Hey, now to the ominous tone when it comes to the macro, as U.S. consumer sentiment slides to one of the lowest readings on record. And as economists anticipate President Trump's trade war makes a U.S. recession almost a coin flip. We head to Washington, D.C. and to Bloomberg's Michael McKee. He's a Bloomberg TV and radio international economics and policy correspondent. He's live in our D.C. bureau right now. Mike, you're wrapping up the meetings at the IMF. I want to get from you just the general consensus, the general tone, the vibes, for lack of a better term. But before that, I want to bring up the UMich data that we got earlier today and really what it told us. What was the signal there?
Well, the signal is the same as it was with the preliminary numbers. These were a little bit better, but they basically say Americans don't think the economy is in good shape, and they're worried about where it's going from here. The question always is with these sentiment surveys is, do they translate that into action? Do they start pulling back? The inflation expectations numbers, certainly not good. A little bit better, by a basis point than they were in the preliminary, but they're still very high. And if Americans are worried about prices going up and they are worried about the economy, they might pull back on their spending. And then you've got a demand problem that slows the economy at a time when tariffs might be something of a shock on the supply side and push up inflation. And that's the nightmare scenario. So you can you can sort of game out bad news from this report if you want to go far enough.
All right. So when do you just kind of speculate that it's going to turn into bad actions? I mean, is there a reading, Mike, that you say, okay, we're there. People are definitely holding back and it doesn't look good?
Well, you'll have to look at the consumer spending numbers, both the retail sales numbers and, of course, the spending numbers that come at the end of the month. But there was a study done a couple of years ago by Danny Blanchflower. You know him well. He's an economics professor up at Dartmouth College that shows there is a strong correlation between big drops in consumer confidence and recessions. And I have been at the other end of his emails where he's been saying lately, I told you, and this is what's going to happen. So we shall see if that does indeed prove out.
Okay, I promised we'd talk about the vibes down in Washington. You've been there the entire week. I'm sure the weather has been great, spring-like, nice in Washington right now. What about the vibes, though? What's the takeaway from the spring IMF meetings and really everyone that you've run into, everyone you've heard from?
I think everybody just wants to get out of this town. The talk, as you say, no matter what comes up, it all ends up back on tariffs and what the U.S. role in the global economy is going to be going forward. And the problem for everybody, besides just the basics of tariffs are bad for economics, is that the uncertainty caused by the president's waffling around on tariffs and what they're going to be is really paralyzed everybody. Countries are trying to figure out how they can defend themselves and protect their economies from tariffs, but they don't know what the tariffs are actually going to be, what they'll be applied upon, when they'll be applied. So it's very hard for anyone to get a clear idea of where we go from here. And of course, we're all in this echo chamber where that's all that gets talked about. So I think people may be glad when this event is over.
Well, that's interesting, too. Like, I do wonder when the echo chamber, like, we just kind of are in this vacuum. We're like, bad, bad, bad. Having said that, Bloomberg did their own survey of economists, and they basically are saying a couple of things. They say the U.S. economy is set to expand 1.4% this year, 1.5% next year. Not great, compared with 2% and 1.9% in the last month's poll. The median respondent now sees a 45% chance of a downturn in the next 12 months. That's up from 30% in March. You're the expert here. I know it's all just numbers. I know it's just a survey. But you go back a few months, we really weren't talking U.S. recession, and now it's part of the narrative.
I feel like we're playing Family Feud here. The survey reflects basically the feeling on Wall Street and among almost all economists that a recession is not necessarily likely, but the odds of it have gone up significantly. And a lot of it is going to depend on what consumers do. We also see the beginnings of a real slowdown in business investment. We saw that in some of the categories of durable goods. We had a big durable goods number yesterday based on Boeing sales, but machinery sales, machinery orders, computer orders, things like that fell during the month. So if businesses are pulling back, and Fed officials tell us that that's what they're hearing as well, then the odds go up significantly that a recession could occur. It wouldn't take much to tip us into one.
How big of a grain of salt should we take surveys, or not surveys such as this, but what economists think will happen? And I think back to, 2-3 years ago at this point, Mike, when pretty much everyone was saying we'd be in recession, and that didn't end up happening.
Well, I think the difference this time is economists know that this is sort of an impossible situation to be in. And I've talked to a lot of them this week who all say that I'm lucky because I get to be an economist who doesn't have to make a forecast. They get paid. They get paid for making forecasts, and they don't have a whole lot of good data to make that forecast upon. So it's very difficult for them to know whether this 45% is a good, strong number or not. I think as we go along and get more hard data, they'll refine their views. But for right now, I think they're just being cautious because the odds are, the story is lining up that we could go into recession, but it doesn't necessarily mean that's going to happen.
Right. And at least they're putting out some numbers, right? They're not saying, well, we could go this way or we could go this way. I mean, it's like kind of an interesting environment, as you know, with corporate earnings where we're getting some CEOs or some C-suites. We keep bringing up United Airlines, but I think there's a few others where saying, well, it could go this way or it could go this way, depending on the tariffs and depending on the U.S. economy. Mike, the Fed speak, you caught up with Fed Governor Waller. I'm just curious how you were thinking about what we were hearing. We're getting ready to go right into a quiet period when it comes to the Fed as well.
Yeah, this is going to be an uneventful one and an uneventful Fed meeting because they don't know. They're not going to make any change at the May meeting. The question then becomes how fast do we get enough data for them to make a decision? Waller said that he wouldn't expect anything until we get June data, which comes out in July, which would put the next move perhaps not. It wouldn't be in June. It would be maybe the July 30th meeting or even September 17th. And I think that Waller is leaning towards the fall before you have enough data to show what's going on, because companies are going to move slowly on all of this. If their input prices don't go shooting up but just start to rise, maybe they'll eat a little bit of it to keep share of business. And if the economy slows, they may be a little more reluctant to let people go because it was so hard to find them before. So we'll have to see how the data play out. They know they'll be behind the curve, but there isn't much else they can do about it at this point.
We got anecdotes from the Beige Book this week. We know the data that the Federal Reserve looks at as they go into their quiet period. How do they look, though, at company earnings? Because we're going to hear from some big ones next week. Are they watching what companies like large mega cap tech public companies are telling investors?
Sure. And of course, they're always talking to the CEOs of companies, especially the bank presidents in their districts. They don't particularly care, I think, about what the earnings per share is, but the guidance is what's giving the Fed some kind of clue as to what's going on. And when you have Delta and American pulled their guidance, and you mentioned United setting up a two scenario guidance. That suggests that the businesses are going to sit on the sidelines for a while, and if that's the case, then the economy slows because it doesn't get the stimulus from investment.
Are we seeing any shift? Next week is a big week when it comes to the job market, right? We get the monthly read from the government on Friday. That's what we'll be talking about 1 week from now. And then we get obviously some lead ups to that.
Little JOLTS action coming earlier in the week.
A little bit of other stuff. So how important is it when I feel like it's almost getting to the point, yes, we know the Fed obviously is on inflation watch, but people are kind of maybe debating, are they going to have to start watching the labor market more for signs of weakness, signs of growth slowing down? So I'm just curious how important the numbers are next week. I know they're always important, but are they a little bit more important next week?
I think they'll be a little more interesting, but not necessarily more important. Chris Waller said yesterday to me that he thinks that unemployment is going to be a more important indicator of where the economy is going than inflation, because his belief is inflation's a one-time move, but if you start seeing people getting laid off, that tends to pick up speed. The thing about this week coming up, the April numbers, is we don't have a clear picture of how the job cuts that the president has forced on the federal government are playing out yet. We don't really know how many people have been fired. I'm not sure all the people who've been fired know they've been fired. And we don't have a great idea yet of what the spillover into the contracting world is. Now, so there should be some impact. It should be noticeable, but is it going to be big enough to make a difference? Probably not. And then longer term, immigration has come to a stop. And so the labor market should start to fall, which changes the denominator on the unemployment rate and could keep the unemployment rate from moving up as quickly. So this week or this coming week, it'll be interesting to see what clues we get out of this, but it won't be determinative in any way because they're not going to move in May.
Mike, just 20 seconds. Torsten Slok out with a note today about U.S. trade between China and trade between China and the U.S. collapsing. Could see empty shells, COVID-like. How big of a deal would that be if that happens? Just 20 seconds.
Oh, if that happens, that'll be a big deal because that's the kind of thing that Americans notice right away, not only prices, but the availability of goods. So that's something to be concerned about. We'll see if the numbers continue on those container ships coming in.
Yep, funny, not funny, the hunt for toilet paper and so much more. We all remember it all too well. Michael McKee.
You hoard in the basement. I know that about you. So we're all going over to the Nasser household if we run out of TP.
Michael McKee. He is, of course, TV and radio, international economics and policy correspondent. Coming up, the CFO of Huntington Bancshares.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Huntington Bancshares reported earnings last week. Some analysts noting how the regional bank based in Ohio seemed to be more optimistic about growth than its peers. For the first quarter, the bank beat on earnings, net interest margin, and more. It also approved a $1 billion share buyback. The stock rallied 3% on that release, but the stock overall year to date is down about 11%. In our weekly check in on CFOs, Chief Financial Officers, back with us is Zach Wasserman. He's Senior Executive VP, CFO of Huntington Bancshares. It is the holding company of the Consumer and Business Regional Bank, Huntington National Bank. It's got locations in a handful of states. We'd like to remind you, Ohio, Minnesota, North and South Carolina, and a few more. And Zach joining us from Columbus, Ohio. Also with us is Nina Trentman, Senior Editor at Bloomberg News, the author of the CFO Briefing newsletter, which you can get at bloomberg.com/CFO briefing. It comes out a new one every Sunday, and Zach is among those featured in the newsletter out on Sunday. Zach, Nina, welcome. Good to have you both. Zach, we want to get right to it. Great to have you here. I think we talked with you in about mid-March last go round, and that was before so-called Liberation Day. What's changed as a result of what we've got from the White House and the volatility and uncertainty that has followed?
Yeah, well, it's terrific to be back with you, and certainly it's been an eventful first start of the second quarter here. But for us, it's continued business as usual for the most part. We had, as you noted, a really strong first quarter. It was, frankly, in my finance career, within the top 5 of any quarter I've ever been a part of. Revenues growing 10%, earnings per share up 20%. With really strong customer acquisition trends and great credit quality. So a lot of momentum actually carrying into the second quarter. With that being said, one of the ways we characterized the sentiment right now on our earnings call was cautious optimism. Certainly more uncertainty today than was the case earlier in the year. With that being said, we're still seeing growth. An indication of that is loan pipelines, our forward projection of likely loan closings, actually higher in the first 2 weeks of the second quarter here from the end of the first quarter. So still seeing that come through, notwithstanding a bit more uncertainty for sure.
Given that you have a regional focus, what would you say is the biggest potential impact from tariff policy on your business? We talk about some of the bigger banks, and certainly the issues around M&A and sort of a pause when it comes to IPOs that have been pulled. That affects their capital markets business, but that's not necessarily where you guys are playing. What are the biggest risks based on what's happening in Washington to your business?
It's a great question. It's a great question, Tim. And I think, for the most part, it is the uncertainty itself. We're seeing somewhat delays in the decision-making process that affects loan activity in our regional bank, for example. I was just talking with our key executive there, mentioned that the loan closing process is taking about 6 days longer, about 10% longer maybe than would historically have been the case. We're seeing some of our segments that really service companies who are key to durable goods, particularly those that where they have a foreign supply chain, that we're seeing some impacts in. We do have an M&A advisory business that supports middle market, largely private companies, and we're seeing somewhat slower deal closing process there. So, we're seeing to some degree those impacts, and that if that uncertainty continues, we would expect to see that those impacts continue and probably magnify. So, absolutely, we'd like to see a resolution of some of these uncertainty. With that being said, as I noted in my first answer, we are seeing generally growth. Loans for us into the first quarter grew 2% from the end of last year, and our forecast for Q2, the quarter we're in right now, is for another 1% to 2% growth. So overall, still seeing growth, but at the margin, some of those impacts.
Zach, to follow up on that, one of the themes in the upcoming edition of the briefing will be controlling the controllables, which is a theme that is coming up in many earnings calls that we're seeing these days coming in. Wondering from your perspective, if you're looking at your business, what are the items that you can actually control?
Yeah, it's a great question, Nina, and I think one of the things that's critical for us, and to some degree, situations like this really reveal which companies are managed the most rigorously. And we always think about multiple scenarios and scenario planning with contingent actions. And so to some degree, this scenario that's playing out right now is part and parcel to the way we manage the company all the time, always thinking about what could potentially come to pass and how we'll pull the levers of the business to maintain, strong relative performance in any of them. With that being said, I always think about three things. Firstly, the key pillars of financial strength for the bank: capital, liquidity, and credit. And those are the things that under all circumstances we want to have strength in. And in an environment like this, we know how we will operate to maintain those areas of strength. Now, the second is the growth orientation of the firm. What are the goals that we're putting out to the organization? Where do we want folks focused? And what's the pace of our investments into key growth initiatives? And then the last thing is, how can we be consistent with our customer base? Fundamentally, one of the most important things for a bank is to be there for our customers through all cycles. And so for us, that consistency of customer interaction, consistency of underwriting, and really making sure that for the customers, we're always there to support them.
Right. Just wondering, actually, you pointed out the importance of credit and liquidity in the current situation. If we go back a few weeks' time, basically ever since the April 2 tariffs were announced, we've seen a strong sell-off in U.S. assets. We've seen investors questioning sort of the stability of the U.S. financial system, and we're also seeing cracks emerging around institutions here in the U.S. With questions around the rule of law, due process. So I'm wondering, from a CFO perspective, how do you think about those impacts to your business now and also for the longer term?
Yeah, I mean, it's a great question. I think to some degree we see ourselves as a bastion of strength at times when there is those kind of uncertainties. You can count on us, as I noted just a minute ago. Our decision-making criteria are going to be consistent. We're there to provide advice and counsel to our customers amidst this time. I mean, to some degree, this actually is a time that bankers relish. And don't get me wrong, no one wants uncertainty and potential challenges to the economic environment. But this is the time when we really prove our worth to our customers. When we help them think through, how are they going to address potential challenges to their supply chain. How are they going to continue to address the level of interest rates, which have clearly risen, and if inflation does reemerge and begin to reaccelerate, how are they going to address that? So it really is a sort of go back to the core. focus on customers, focus on their best interests, and really help them to be ready amongst this potential uncertainty.
Hey, one thing I want to ask you, just to follow up, Zach, on Nina's question, and especially when it comes to the rule of law. We are living in an environment where it's being tested. We're seeing a consolidation of power by the president in the White House. We have a story this morning that is among our most read on the Bloomberg about a state judge in Wisconsin arrested by federal agents after an investigation into whether she obstructed officials trying to detain an undocumented immigrant. And I guess whether that was legal or illegal, the point is we're living in a very different, at this point, it feels like United States of America. So how do you think about it as a CFO? We're looking to our leaders, trying to understand the way forward. And how do you think about what could be a very different, potentially, country going forward and operating within one?
Yeah, it's hard to speculate on how things will go and how the operating environment could potentially change. We walked into this year with an expectation that the regulatory environment would continue to evolve and be very constructive to growth, and so we're certainly looking to see that. But we try to get out of the game of speculation and really just continue to focus on the core of what a bank is, which is financial strength and supporting customers.
Zach, forgive me, like, not even speculation. I mean, we're seeing things happen that, it's not business as usual in terms of how things are run. And I am curious, and we're really leaning on folks like you and all leaders that come on Bloomberg just to try to understand, is it upsetting and hard for leaders too to see things not kind of business as usual, potentially, becoming the target of the White House?
Yeah, look, I mean, I think we want to see certainty and clarity and to have an operating environment which is clear. And so to the extent that it's not, that's not helpful for us. With that being said, and again, I kind of come back to what's the role of our company? We're not a legislative body. We're not a political entity. We're there to help serve our customers. And this is the time when, to some degree, the culture of Huntington certainly is all about service. And we just double down on that at times like this and just try to be that bastion of strength, that pillar that people could always count on. And that's where we draw inspiration.
Well, speaking of service, you mainly operate in the Midwest, and I'm wondering how you're servicing manufacturing and auto parts and auto-related clients and how those are intending to manage supply chain challenges. What can you tell us about that? What color can you give us from what you've heard from them?
Yeah, look, I think certainly, as I noted earlier, the folks that are really the most keyed toward foreign supply chains, there is some concern, and I think it's affecting decision making, it's affecting some of their investment plans. With that being said, I also, generally speaking, I think we're seeing from our customer base that this is not totally unexpected. We saw from the first Trump administration that tariffs were a major part of the agenda, and certainly during the election cycle that came up as a major likely focus. And so folks knew that something was coming, and they were beginning to think through that. And so, for the most part, we're seeing us calm, more calm maybe than the headlines generally would indicate. And I think likewise, if you think about the commercial sector, there's been a number of challenges over the last 5 years. COVID, rapid rise of interest rates, high levels of inflation. And so I think for the most part, we're seeing resiliency, more resiliency perhaps than the headlines would imply. I don't want to be Pollyanna here. If this uncertainty continued for a long period of time, you would see things more markedly deteriorate. But thus far, we have not seen that.
That's why we like to talk to folks like you. Zach, thank you so much. Really appreciate really weighing in on our world environment. And like we said, he's got a very optimistic view, and we saw that play out in their earnings and certainly investor reaction. Zach Wasserman, CFO of Huntington Bancshares, and our own Nina Trentman, senior editor at Bloomberg News. Check out the CFO Briefing newsletter, a new one out on Sunday. This is Bloomberg.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're going to talk about someone who has been a fixture, no doubt about it, of the global investment world. His financial moves watched closely, one of the very successful and uber-rich members among Middle East royalty, and yet As Bloomberg's Devin Pendleton writes, Prince Alwaleed bin Talal is one of a kind figure among the rich and the powerful in the Middle East's Gulf region. Devin has been at his top floor office in Kingdom Center. It's a landmark of the Riyadh skyline several times. She is Bloomberg News wealth reporter. Her Bloomberg exclusive on Prince Alwaleed is today's Bloomberg Big Take. It's also among the most read on the Bloomberg on this Friday. She joins us here in studio. Really great story about someone that I feel like at one point, Devin, we talked about him constantly over and over again in terms of his investments. And then, you know, he kind of got quiet. And then there, of course, was a big thing that happened over in Saudi Arabia. Take us back to kind of who he is and then kind of the moment it feels like things changed.
Sure. Well, thank you. Thank you, Carol. Thank you, Tim. So Prince Alwaleed he's a Saudi billionaire and he's a member of the royal family. The royal family is huge. There's thousands of members. So he is related to the king, but not like in the kingly line of succession as we think of it. But a prominent member and very, very entrepreneurial from a young age. He attended college in the U.S. and started investing here and there in Saudi Arabia. But the reason we all talk about him and know him is that he made a bet on Citibank back in the 80s when it was really struggling. That bet did tremendously well. For a long time, he was Citi's biggest shareholder. He went on to form relationships with Rupert Murdoch, with Bill Gates. He bought a stake in the Four Seasons. He bought a stake in News Corp. He had a stake in Disney. He funded Euro Disney, all over, and also a very prominent hotel investor with some amazing properties. And just like a larger-than-life character. He was a fixture, like you said, always showing up on financial television. Yeah. Loved to be quoted. He always traveled with a motorcade. Like, he had an entourage with him. Incredibly lavish lifestyle. And
then pretty much overnight, November 2017, everything changed.
Everything changed. So in November 2017, this was about a year and a half after King Salman became king of Saudi Arabia, and his son, Crown Prince Mohammed bin Salman, was really just basically running the show in Saudi Arabia. Incredibly young and ambitious guy. And he locked up hundreds of, the elite of Saudi Arabia, not just businessmen, but also governors, government ministers, prominent people, philanthropists, business people, detained them at the Ritz. And that included Prince Alwaleed, which was a big deal because Prince Alwaleed at that point, like kind of prior to this moment, was really like for the US, maybe the most famous Saudi. He was what a lot of investors thought of, or Wall Street thought of, if you mentioned Saudi Arabia, because Saudi too was so private and closed off for so long. Like, it was difficult to crack. They weren't investing. Like, it is nothing like it is today. Alwaleed was detained there for 83 days. Nobody really heard from him. They took everybody's phones. After 83 days, he was released, and Bloomberg actually had the first interview with him when he came out. He said, everything's good. He didn't look so great. He was quite thin, but he assured us everything's good. He said he'd struck an agreement with the government. He couldn't say anything about it, but just said, business is normal. And it was like, oh, okay, all right, business as usual. But he has a very, very big, prominent investment company called Kingdom Holding, which has stakes all over the world. And he pretty much went quiet, after he got out of the Ritz. He gave that one interview and then didn't nearly have the same public profile that he had before.
What I love is you say the terms of the agreement were secret, but it was clear the Saudi government had a close interest in his portfolio with his stakes in hotels, aviation, and entertainment, all sectors overlapping with Vision 2030. So what do folks say? That they wanted to exactly know what he was invested in? Or so what do we know?
So we know, he owned 95% of Kingdom Holding, this big publicly traded conglomerate before. And in 2022, the Public Investment Fund, or PIF, bought roughly 18% of it. So they actively had a stake at this point. They definitely had an interest before. And I think a big reason that this his investment empire was interesting to them is that he, for a long time, has invested in hotels and airlines and entertainment, and these are all core sectors that are very important for Vision 2030 as they try to diversify away from oil and, become a tourist destination. And he's very useful for that. Like, he's been a hotel investor for a really long time. He has relationships with Bill Gates and the Four Seasons management. And so you've seen a lot more domestic investment by Alwaleed in very specific projects.
Some of those projects include projects by none other than Elon Musk. And I was pretty taken by one of the things that he told you. He said to you in February, when you were having one of your Zoom calls, Musk is de facto vice president and running the show in Washington.
Yes. And he was saying that in the context of talking about the value of X at that point. Because, we're all looking at X and thinking, gosh, its value has kind of really fallen, like since Elon took it private, and we saw so many advertisers flee. That had a big impact. It was roughly $44 billion gross valuation when he bought it. Alwaleed's had tremendous conviction that it was worth more than that. So, one of the first things he said to me was like, hey, this is a valuable entity, and you can't say that it's not. Look at where Elon Musk is now.
Okay.
It, speaks for itself.
I mean, how close are they? Do we know? It's obviously there's investment connections and a relationship, but I mean, how close are they?
I mean, he told me they speak every week. They didn't know each other until 2022.
Yeah.
Alwaleed was a longtime investor in Twitter before it was even a public company, and he didn't really know Musk until Musk stepped in to buy it. But Alwaleed totally immediately threw his hat in the ring and said, I'm in, I'm going to roll my stake over. Let's do this. So that meant a lot to Musk. And he said they speak regularly.
Why do this story now?
Because it was so marked, like after so many years of him being quiet, all of a sudden he is taking to the airwaves in a way that we haven't seen in so long. And it really was reminiscent of the Alwaleed we used to know. Just this big, colorful guy with some very important differences.
What's his relationship with the president?
So he's a supporter. He has a long history with him, actually, in this time in the 80s and 90s, go Wall Street. When Trump was mired in debt in the early 90s, Alwaleed kind of bailed him out. He bought his yacht, which he still owns. A few years later, Trump's still in debt, and Alwaleed and another Singaporean billionaire bought his stake in the plaza. So he says, he loves to say that I know how to negotiate with Trump. I know what he's doing. I've dealt with him before with the tariffs, for example. When Trump was running for president in 2016, or the run up to that, he had his Muslim ban. Prince Alwaleed was not a fan of that. They actually sparred on Twitter. But very quick, they papered things over. He's very happy with his treatment of the Arab world.
Fascinating read. Highly recommend everybody check it out on the Bloomberg. Devin, thank you. Really appreciate it. Devin Pendleton, she's Bloomberg News Wealth reporter. This story is among the most read. It is the Bloomberg Big Take. Find it at Bloomberg.com or on the Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just got about 18 and a half minutes to go until we wrap up the trade. On this Friday, also for the week overall, we've got kind of a mixed market, but up on the S&P just slightly. You heard Charlie and Bill Maloney breaking down the numbers, just up about 22 on the S&P 500. NASDAQ 100, a gain of about 0.7%, up 134 points. Back to the S&P, up about 0.4%. And you've got the Dow just down about 0.1% here. But we have seen, as Tim mentioned earlier, most names, a majority of the names in the S&P 500 are lower. So more of a risk-off trade on this Friday. But we are up pretty significantly for the week overall.
Thank you, Mega Cap Tech.
Yeah. Woohoo.
Yeah. We'll see what happens next week. We got Apple reporting.
Yes,
we
will.
Platforms. We got Amazon.
Yes, we will.
Hey, let's speak to Adrienne Yamaki. Bring her in. She's founder and managing partner of Strategic Wealth Capital. They've got about $230 million in assets under management. She joins us from San Francisco. Adrian, good to have you back with us. It's been kind of a wild ride this week. As Carol mentioned, the S&P 500, it's on its best 4-day streak, Carol's going back to January?
Something like that. Yeah.
Something like
Pretty
that.
Significantly.
So don't quote me on it. Something like that.
Sorry.
That's okay. But as Carol reminds us all the time, what fundamentally has changed when it comes to the trade war? Not necessarily
on track
much.
for its longest advance since January.
There we go.
Well done, Mr. Stenovic.
Okay. So we got that one right.
Sorry, Adrian.
What are you hearing right now from clients?
The trickiest thing right now, of course, as everyone knows, is not just the uncertainty of what's going to stick. So with tariffs, with interest rates, since there have been a lot of reversals, but it's what I have found. A lot of my clients are New York, DC, California, and the values of and the policies of the administration have been a bit hard. So one thing I am telling clients to do, I have had more than one family ask if they should move abroad or move their assets abroad, which I have not had before. I know. I do have a client who is also going to be moving to Europe and getting a passport. I can say I've never had that before, but I talk it through with them. One thing that I do counsel everyone, regardless of political persuasion, is to just try to separate the business, the stock market, their earnings and companies from the government piece. It's not easy, but when you're making the financial decisions, you have to try to be able to separate emotionally from the two.
Wait, so why are they doing it? What did they tell you why they were doing it?
That's such a good question. It was really interesting. So one client said, I'm worried that the current administration will dissolve a lot of protectionist measures we have, like insurance for savings accounts. And she was concerned that because if we're no longer, for example, a reserve currency, and if our currency goes through severe devaluation, she wanted to be sure that she would have enough funds. She has quite a lot of savings, and was wondering, should she hedge against currency? And my answer in her case, because if someone is planning to move abroad, I have clients who own properties in multiple countries, that might make sense. But the risk of moving it abroad to euros, for example, and back when it's going to be ultimately spent in dollars didn't make sense. And for most people, it doesn't.
So what did you advise her? Just do nothing? Because she's obviously anxious about what's going on here. And look, anecdotally, I've spoken to people who are very anxious too, not necessarily taking steps as drastic as that, but definitely selling U.S. assets and buying assets outside of the U.S.
Yeah. So it's, I think the last time I was on the show was, I think the first or second business day of this year. I was just looking through that when I was reviewing my notes.
Different tone, different sentiment, different narrative a little bit?
Different sentiment, but my advice. Yeah. So the consistency of asset allocation and diversification, that's always going to be important. And so I had talked about international assets. Yeah. And last year, I talked to a number of clients who said, I don't like Europe. They have high taxes, slow growth, slow population growth. But what we had talked about in January was, yes, but you're investing in multinational blue chip companies that happen to be based abroad. And I know we had talked about like Toyota and Honda companies that build abroad. And we talked about European consumer product companies. Even with the tariffs, if you look at the makeup, a lot of these companies have sales outside of the U.S. And it's funny because in only 3 months, 4 months, we've seen, the IFA is up about almost 9% I saw today, and S&P is down about 6%. So if you look at the difference, that's 15% in 4 months? Yeah. It's a lot. The timing, nobody knows the timing, but if the fundamentals are there and international was trading at discounts, it's going to be the case that everything will revert to the fundamentals. And it did. But what are the fundamentals? Because we expected.
What are the fundamentals, though? Because the U.S. has outperformed over the past decade or so. And, those people with global equity portfolios have said, okay, this is the year, when things kind of revert to the mean. Is the era of U.S. exceptionalism and U.S. outperformance over?
So there are two things that we're talking about. One is the stock market, and the other is the U.S. as a country which has top institutions and quite a large presence on the world stage. I mean, from education to research and technological advances. The short answer is, on the business side and the market side, companies are much more nimble than governments. And when some of this uncertainty clears up, and it's always going to exist in some form, I'm not concerned about the companies. The U.S. companies will find ways to remain profitable. I am more concerned, however, about the U.S. as an institution. It's not a fear so much as I think the cornerstones that the administration is trying to change. I think that will be detrimental. Even if we just look at universities, if students are afraid of coming here and researching and staying and starting businesses, it's going to be tough to remain exceptional.
Okay. Because, Adrian, it sounds like it's really going to be too also hard to separate, because I feel like the markets and the government, while separate, are connected. You know what I mean? So I do wonder how, if there's no faith in the U.S. government, what that does to kind of the whole U.S. marketplace. Like, it's just...
There isn't...
Just got 20 seconds or so. Yeah, so go ahead.
It's not we don't invest in the governments. There's a lot of interplay, but the most important thing is to look at the earnings of the companies. So just like when we invest in Europe, we're not investing in a specific country's government. Yeah. We're investing in the companies that are domiciled there.
Interesting.
It's absolutely the same thing for us as well.
All right. That's an interesting perspective. Good perspective to hear. Great to talk with you. Have a great weekend. Adrian Yamaki, founder and managing partner of Strategic Wealth Capital, about $230 million in assets under management, joining us from San Francisco.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.